In this video, I'm going to dive into retained earnings in more detail. So retained earnings is one of the key shareholders' equity accounts. And I'm going to break this down into two words, right? So retained and earnings. So another word for earnings is that of net income, or you can even say net earnings profit. So net income, net earnings profit is derived from the income statement, which is revenue minus expenses. So net income equals to revenues minus expenses. So essentially, retained earnings are net income, net earnings or profits that we retain within the business. So when we have net income, there's two things that we could do with net income. One is we could pay it out as dividends. And second is we could retain it within the company. So essentially, dividends is a payment that we make to our shareholders saying thank you for investing in our company. So to kind of rewind a little bit, common shares or preferred shares are issued for cash for ownership stake within the business, and the company could declare a dividend or they cannot declare a dividend. So that's up to them. So I'll give you a prime example of this. So let's just say it's year one of our business. And let's just say, so essentially to kind of rewind, the formula to calculate ending retained earnings is going to be beginning retained earnings plus net income minus dividend gives us ending retained earnings. So that's the bare basic formula. So essentially, if it's the first year of our operations, our beginning retained earnings is going to be 0. So let's just say in the first year of operations, we earn net income of $2,000. So let's just say this is our business now. We decide, like, you know what's the first year of operations, we shouldn't be paying out any dividends to our shareholders just because we would rather reinvest it into the business and grow our business. Because when we reinvest the money into our business, we could use that money to buy inventory, to buy land, building, equipment, things like that, so we could further grow our business. So in year one, we decide to not pay out a dividends. So that means our ending retained earnings is going to be 0 plus 2,000 minus 0 is going to be $2,000. So if you think about this from a logical standpoint, ending retained earnings December 31st, year one is $2,000. The very next day is January 1st, year two, which is going to be the beginning balance. So the ending balance in year one is the beginning balance in year two. So let's just say in year two now, we earn net income of $10,000. Business is doing great. So we're like, you know what? Let's pay out a dividends of $2,500 now to our common and preferred shareholders. So in this case now, we declare a dividends. Remember, a dividends is not an obligation unless we declare it. Very important. Once the board of directors declares it, then we have to pay that out no matter what. So in this situation, the ending retained earnings is 2,000 plus 10,000 plus negative 2,500. And that means our ending retained earnings is 9,500 now. So once again, if our ending retained earnings balance in year two at December 31st is 9,500, that's the very next day is January 1st, year three. That's our beginning inventory balance, 9,500. Now let's just say that in year three, business has gone downhill. We're like, you know what? This is tough. We actually had profits of only $1,000. So we're like, you know what? $1,000 profit, business has gone downhill. You know what? Let's not declare a dividend. So once again, our dividends that we're going to pay in year three is going to be 0. Now our ending retained earnings is 9,500 plus 1,000 minus 0, which is 10,500.